Hi, I'm Jette Ferguson with Sotheby's International Realty, and I go by Jette, and this is Jette TV. Today I'd like to welcome Jeff McMullen, Senior Mortgage Advisor with Cal Financial.
Yes, ma'am.
So today I'd like to talk about PMI. What is it?
So PMI is private mortgage insurance. Typically when you buy a house and you put 20%, less than 20% down, your banks require, because they feel like it's more of a risk, they require insurance to be bought. So you're not buying your own insurance, you're buying mortgage insurance for the bank. So they take out an insurance policy so that if you ever default on that loan, they're covered.
Right.
Right?
And that was kind of recent. I mean, we didn't always have mortgage insurance, did we?
Well, we've had it for a while, but for a long time there's been a stigma around it. Well, I don't want the PMI. Like I hear every day people say, I don't want PMI, it's too expensive.
I always thought it was like $300 a month extra.
Yeah, so what's changed is there used to just be one or two insurance providers for mortgage insurance, and now that I can think of, there's either 5 or 7 just that we know of.
Okay.
And so that competition has really driven down the price. And so in a lot of cases, we're recommending to people, so say you're buying a house and you have 20% down, but that's going to be the majority of what you have to put down.
Okay.
There are cases where I'll tell people, why don't you put down 15%, you'll take your mortgage insurance, because if your credit is good, that's what mortgage insurance is based on, it's based on credit and down payment. So at 15%, there are times where it only changes the payment $50, but then they can keep 5% down, and then they can put the paint on the house that they want when they buy it, they get the yard they want, and they can really use those funds. Yeah, so I like showing people that. So what we'll do is we'll just do a side-by-side comparison. Most of the time we'll send them a cost estimate that breaks everything down. But if you look at the difference in payment, a lot of times it's worth having that PMI, which eventually does go away, which is different than
because
an FHA
it's
loan.
not an FHA loan.
Correct. With conventional loans, once you get to that 80%, the mortgage insurance actually goes away.
You have a reappraisal, I suppose?
You can, but there's also, if you get to the 80% of the original purchase price, it goes away. So like if you just put a big chunk of money down, it will go away.
Okay, perfect. And versus FHA, just tell people what mortgage insurance is like with the FHA loan.
Right. So FHA is a different type of loan. That's a government loan, and it's made by the Federal Housing Administration. FHA mortgage insurance is the same for everyone. It's not based on credit, so that mortgage insurance is typically higher than conventional. It's also permanent. It doesn't go away unless you put down more than 10%. And even then, it only goes away in 11 years. It doesn't go away right away. So as on a conventional loan, you can put down and expect that mortgage insurance to go away in 3 to 5 years, where FHA, you know for sure you can't get out. At best case 11, or in some cases you can't do it at all. So if you put down the minimum down payment, which is 3.5%, that mortgage insurance never goes away.
So what are you doing? Are you doing more FHA or conventional loans when it's under 20%?
This year our mix was pretty much, I think we did 20% VA loans. I think I only did about 10 or 15% FHA loans, because conventional loans, they look better in most cases.
And you do 3% down on conventional, right?
Yeah, in some cases.
Yeah. Okay. Well, thank you so much for explaining that.
Yes, ma'am.
And why don't you tell everybody your phone number?
Okay, I'm at 831-210-4034.
That's 831-210-4034?
Yes, ma'am.
And I'm at 831-402-3800. Again, 831-402-3800. This is Jette Ferguson signing off, Jette TV. Thank you.